The Economic Intelligence Unit of the Ceylon Chamber of Commerce launched its 11th Annual Outlook Report 2026 today with the participation of Central Bank Governor Dr. Nandalal Veerasinghe.
While the cyclone caused loss of human life and significant damage to infrastructure, the overall impact on business has been less severe than initially anticipated. In agriculture, paddy crop damage is estimated around 10% and is manageable through existing buffer stocks. Food prices, including vegetables, stabilized quickly after initial volatility. In tourism, industry estimates suggest losses of around 500 million rupees to hotel properties, which remains modest relative to the size of the sector. From a financial sector perspective, less than 1% of total loan portfolios were directly affected. Across SMEs and retail value chains, disruptions appear limited. Overall, while Cyclone Ditwa resulted in a temporary setback, the private sector outlook points to resilience and a rebound, supported by consumption, tourism momentum, and reconstruction-related spending. Turning to the broader macroeconomic context, Sri Lanka today stands on a clear and credible path of economic revival. After a period of immense challenge, we are now seeing steady and broad-based growth, a resurgence in exports, tourism, remittances, and investment, and fiscal consolidation supported by key reforms. The completion of domestic debt restructuring, inflation being firmly brought under control, and renewed confidence to markets and consumers alike together signal a much more stable economic environment.
Let me talk a few areas. One is the cyclone impact. Basically, impact is less than expected. Cost of recovery or the government will have to spend is probably less than what was expected. This is why government has been able to announce additional 500 billion for this year to spend on this sector. So I think in terms of, I think one important part here on the impact of data two ways. One is on the growth. Obviously, there could be a little lower growth for Q4, that is numbers will come out soon. And as a result, what we see this year growth may be around 4.5 around what we see. And next year, we see we'll get back to a normal growth trend of close to 5% this year, especially supported by additional fiscal stimulus. That's going to happen in the reconstruction and rebuilding of infrastructure and some of the compensation given to the people who have been affected. Government has been running a 1 trillion deficit with two state banks. It's converting 1 trillion surplus because of the overperformance of the fiscal for last couple of years since the crisis. So that has been quite useful. Now it has become very useful saving to meet this kind of shock, even though smallest shock in the fiscal side. This year, obviously, the primary expenditure target, there is a provision in the Public Finance Management Act to deviate in this kind of event. Government this year will deviate from what they call 13% of GDP, a little higher by about 1%. End of last year, we have 6.8 billion reserves. In January and February so far, we have been intervening heavily in the market to build reserves. It will continue this year. We are hoping to build at least 8 billion by end of the year. Right now, going around 2%. Our target is to reach around 5%. We are very confident that we can maintain inflation around 5%, which means our policy rate 7.75. And compared to inflation forward-looking basis 5%, we still have a 2.75 real interest rate buffer, which is a comfortable buffer